Same guy, same blue shirt, but we got a tiger this week. Find out why and how it can help you make sense of market volatility. I'm up working out earlier this week, and on CNBC, this guy comes across the news saying, the markets are going crazy. And obviously, it's been an interesting few weeks, few months. If you read the commentary below as part of this week's written commentary, you'll see a chart that, for the last year, there's been a lot of volatility while markets have moved sideways. But his comment about the markets had gone crazy reminded me of an old Chris Rock bit. I promise I'm not going full Michael from The Office. We're going to keep this PC and PG. But there's a great Chris Rock bit about a tiger, talking about the Siegfried and Roy incident from a few years back where the tiger attacked him. And he was talking about how dismayed he was at how people were surprised and that the tiger had gone crazy. And he's like, the tiger didn't go crazy, the tiger went tiger. He's like, if you put your head in a tiger's mouth, it biting you is a very natural thing. What wasn't natural is that tiger riding around on a little tricycle. Helps explain markets a lot too. My pathetic little tiger here has got sharp teeth, if you didn't notice. Why? Because tigers are scary. If you saw a flat-toothed tiger, that would be pretty weird, smiling at you like Tony the Tiger from the Frosted Flakes. But they don't have to be fatal. And that's the same with markets. A 2017 where you have a flat year, no drops of more than 2% the whole calendar year, that's weird. That's a tiger on a tricycle. Most markets look volatile. And I know when people reach out to me about that market volatility, when you get a 5-6% drop, which can feel like a ton to people at a given point in time, and they ask, what now? What do you think's going to happen? What should we do? The answer they're hoping that I'll give them is, sell and run for cover, avoid all these horrific losses that were going to come. But that wouldn't be the truth. It wouldn't be helpful. I've got a chart I want to walk you through that shows you exactly why, from a historical perspective, you need to, again, embrace that the market's a tiger. So why do we want to deal with this tiger? Why do we want to put up with this scary thing that can be the market on many, many occasions? Well, the answer is to, again, make money over time without having to pick up a shovel, without having to push a broom. It really can be, again, a passive income, a passive way to make money, but you're gonna have to get through some things, and that's really the point. There is nothing that you get in this life for free, and the cost that you have to pay as an investor is putting up with volatility. It comes with the course. Those periods, like I alluded to a moment ago in 2017, are wonderful to enjoy, but they shouldn't be your expectation. And just because that tiger bares its teeth doesn't mean that all is lost. I want to walk you through a chart. It's one of my favorite charts out there. This takes us through 2017. I'll remind you of 2018 if you need to remember. But really quickly, what it shows you is the blue line is any drop that the market had intra-year from 0 to 10%. The yellow line, 10 to 20, and anything in the red there is a drop of 20% or more. The blue bars, which you can see in almost all cases are up, is the calendar year return for the S&P 500 despite those drops. So what do we see here and what I want to take away? One is there's always red drops. You're always going to get some volatility, and again, the majority of them are going to be in that 0 to 10% range. Historically, since 1926, you'll get a drop in that 5-ish type percent 3 times a year. Now what happens is investors see that drop, they think it's going to lead to 10, that 10 is going to lead to 20, but if you grab anything away from this chart, grab this. There's a bunch of little red dots in the blue bar. There are very few that make it down into the yellow bar as a percentage, and even fewer that made it down into the red. And so that instinct that's, again, natural, and we're here to help walk you through it when it rears its head, of, hey, this 5 is just the beginning of the next 10, which is the beginning of the next 20, historically and statistically isn't true. The other key point here is, while that red dots and red on your balance sheet at a given point in time in terms of your month over month or quarter over quarter gains is the life of an investor, most of those years are still going to end up, or historically have, being positive if you can wade through it, and bear with that volatility. In conclusion, the piece that you're looking for to come from the market at a given point in time, from a certain number on a monthly statement or in an account balance, is really only going to come from, one, a historical understanding of what to expect from markets. That again, the tiger is going to be a tiger, but that's okay. And two, from having a great plan. What does this volatility mean historically? What does it mean to you in particular? Does it mean that you need to delay some certain things? Does it mean that it's a great opportunity to make a shift in allocation or to dollar cost average into a position? That's where we've seen, and again, I've been at this now for a couple decades, real changes get made. People be able to move from the angst of the tiger baring its teeth to greater peace of mind of knowing what is my plan when the inevitable volatility comes to get through it. Be that the plan, be that the income that's generated, be that the ability to be flexible when you're going to have a financial event in your life. And that's what we're here to help you do to get, again, that clarity and that comfort that can be yours as an investor. Thanks so much for joining us this week. Hope this has been of help. Happy to send anyone the chart that would like it. Thanks so much.